Good afternoon, RGEA members and guests. Welcome to today's webinar, Proactive Tax Planning for 2026, presented by Kevin Cecil, Wealth Advisory for Cecil Financial. Taking a proactive approach as opposed to a reactive approach is always better, he says. So today he will cover the ever-changing tax laws, RMDs, plan conversion benefits, family tax bracket management, charitable distributions, and more. I am your host, Daryl Davis Fulmer, and today I want to also thank Tracy Eubanks for her technical support. We're also joined by our Director of Government Relations, many of you know Jackson Kozort, who will give you a brief update. Jackson, you ready?
Yes, ma'am. Dr.
All
Darrow,
right.
thank you. And I really want to thank everybody for joining this webinar today, and especially thank all of our members out there who are on this webinar and who are watching it afterwards on YouTube. We could not do this without you, and so we really, really appreciate you guys being members of this association. And that being said, I did promise Dr. Darrow that I would keep this brief. But did want to give everybody an update. We have kind of three big important things that are going on right now. The first one is I am very, very happy to announce that the treasurer concluded the 2025 calendar year with a 13% investment return. That is a big deal because, as a lot of you, especially local retirees, know, the only way for the elders, the local retirees, to get a COLA or bonus is if we get a 6.5% positive return average over 3 years. And we have had some not very good tax returns over the last decade. I'm sorry, investment returns over the last decade. And so to see this 13% positive return for 2025 is a fantastic step in the right direction. That provides a way for COLAs in our future and is a light at a very long tunnel that we desperately need. Another big update, I'm sure everybody's wondering about the state budget. We still remain the only state in the country that has not passed a state budget. But the legislature is sticking by their guns. They have said that they are not going to pass a budget until the primaries are over, and they have stuck to that. They have not done any sort of budget work and do not plan to, from what we heard in leadership in both chambers, until they start session at the end of April, early May. So we still have a little bit to wait. Because they were waiting for those primaries to get done, which leads to the biggest news, the primary elections that just happened the last few weeks. Big things happened in the House, especially on the Democratic side. There were three incumbent Democrats that lost, which really will kind of strengthen Governor Stein's veto, because the three people that lost their primaries all have the same thing in common. They were all three Democratic members that sided with the Republicans to override some of Governor Stein's vetoes on some of the most controversial bills of the year. So that's going to do a big job in strengthening his veto power in the upcoming 2027 session. It leaves a big question mark for what's going to happen during this 2026 session, into whether these people that lost in these primaries are going to side with on the other side of the aisle for all the rest of the veto overrides that still haven't been voted on yet. It's a big question mark to see what's going to happen. But the big one that the whole state and pretty much the country is talking about is the Phil Berger race. He is president pro tem. He was running against the local sheriff of Rockingham County there. Even though Senator Berger raised 34 times the amount of money as Sheriff Page, he still ended up that night just 2 votes behind. 2 votes out of 26,000 votes cast. As the provisional ballots came in, the sheriff strengthened his lead to about 23 votes. But as we all expected, Senator Berger just yesterday officially filed for a recount. But it was kind of odd. He filed for a specific recount. Most times when you file for a recount, they just run it through the machines again for the first time for the recount. But he asked for something specific. He wanted like a hybrid recount. He wanted to run it through the machines, but he specifically picked out 220 specific ballots that he wanted them to look at very closely, because these were ballots that didn't vote for every race, and he wanted to make sure that everything was on the up and up. But we're going to keep you updated As it goes, the next few days are going to be very important to see how that election goes because he is the most powerful man in the Senate, and some people might say the most powerful person in the state. So if he loses, it's going to be a big shakeup in the way the Senate runs. But I know that was a lot of information in a little time. I promised Daryl I'd keep it brief, so I'm going to kick it right back to you, Daryl.
Hey, Jackson, great job. And thank you so much for all the work that you're doing and having the most knowledge about what's going on um, around the legislature. Thank you so much. So, our
Thanks.
primary presenter today is Kevin Cecil. He founded Cecil Financial in 2007 and serves as a wealth advisor. He earned his bachelor's degree from North Carolina State University and continued his education to obtain his certified financial planner designation. Um, he believes that a holistic approach is best when addressing a client's financial portfolio and that planning for the future should feel productive not challenging. We're looking forward to discussing the great topic of taxes, Kevin, today. So before we begin the webinar, though, I want to go over a couple of things. Each of you has been muted to ensure that the presenter can be heard. This presentation will be recorded and we will send you the link to the recording along with the PowerPoint in our follow-up email. For those of you who sent questions, we submitted them to Kevin and many are already incorporated into his presentation. If you think of a question during the presentation, please use the Q&A button at the bottom of the Zoom page. Those of you on the phone, we don't have a way to really connect you with questions, but if you have any, we'll give you a way to ask those questions through the follow-up email. The team will respond to questions that come through during Kevin will during the presentation if he can. If not, they will happen after the presentation during the Q&A time. So without further ado, let's get started. Welcome, Kevin.
Daryl, thank you, and good afternoon, everyone. As she said, yeah, we're going to be looking at some proactive tax planning for this year. Tax planning is one of the pillars of our firm. We believe that that's one of the main things that you can control when you're doing a financial plan, planning for your finances. We all want to make money in the markets, but the markets are sort of out of our control. Living through times like we are right now, that goes without saying, but how much we pay in taxes, we can control that a little more. So that's one of our main focuses. So that's kind of what we're going to talk about a little bit today. And even though we're planning for, so we want to be proactive, like Daryl said. I know we're kind of all doing our taxes right now, but that's a backwards look. We're looking at 2025. There's still a couple of things that you can do. Maybe put money in a Roth IRA or a traditional IRA. So you can still do some planning for last year, but really want to get you thinking about how do I start tax planning for this year right now while it's fresh on my mind? What can I do proactively instead of waiting till the end of the year or even into next year? So that's really kind of a proactive approach. At a really high level, we kind of like to break down and look at taxpayers in three different categories. As y'all can see, you've got the lower tax brackets, the 0, the 10, and the 12%. That's kind of our to play. That's kind of our no-brainer. We like paying taxes, but well, nobody likes paying taxes, but we don't mind paying taxes in the 0 to 12% ranges. Now, if you look over to the tax sensitive, the 32, the last bucket, the 32, 35, 37, they're really tax sensitive. We're really trying to look at ways to, defer taxes as much as possible when you're in that bracket. And then, of course, that middle bracket, that 22, 24%, those tax rates, that requires calculation. That's like, where am I going to be now? Where am I going to be later? Which kind of leads into the categories of our strategies. You've got taxes you pay now, immediate taxes. You've got taxes you're going to pay in the short term in the next couple of years. And then long term, kind of looking at retirement planning and legacy planning, like what long term does this affect? The taxes planning is almost always a trade off. What do I do today that affects me in the future? Of course, last year, I'm sure almost everybody heard, the tax bill the one big beautiful bill was passed in July, and a lot of what that did, that kind of everything was going to sunset. Everything from 2017 till last year was going to go all the way back to the 2016 tax levels. But the bill passed and everything was the sunset went away and all the tax brackets were made permanent. Now, made permanent when you're talking about tax planning is just an interesting thing because every time Congress changes, half the times tax bills, I mean, changes to taxes happen almost every time. Um, let's get into a couple more. I'll start to get into the details of it. Made these seven tax brackets. It made them permanent for now. Sometimes it's easy to look at the single or the married filing jointly columns. Everybody looks at if you make. Sometimes people get confused on if I jump into a new bracket, everything that I make in that bracket is taxed at that new level. And just to kind of clarify, that's not the case. If you're single, the first $12,000 that you make is in that 10% bracket, and then you jump the next dollar above that is going to be in the 12% bracket, not all of your income. And a lot of times we just try to look at these thresholds and try to figure out where is a client or where's a couple going to be? Is there something we can do to keep you in a lower bracket? And then long-term planning during retirement, what is it? What bracket does it look like you're going to be in? But at least for now, these brackets have been made permanent. Kind of the same for long-term capital gains rates. They're relatively speaking, these are pretty attractive. They're lower than they have been historically. This is a lot of times if you've got an investment account, investment property. I know some people talked about selling different real estate, different things on some of the questions. If we can control your taxes and get your income below the 98,000, then maybe we can keep you where you're not going to pay anything for selling long things that are going to create long-term capital gains. And then most people are probably in this 15% long-term capital gains bracket because that for a married couple goes all the way up to 613,000. So anything above that 20% long-term capital gains rate, that doesn't really include a lot of people, but it's something to be mindful of when you're looking at either investment account or a property that you're going to sell. What capital gains am I going to be paying? I'm going to click through all these. And like I said, some of the provisions, it made the higher standard deductions. We'll kind of go through those. It made those permanent. We'll get into the temporary deductions for seniors. That's probably pretty pertinent on this call. It also raised it brought back state and local tax to include a lot more people that were getting a deduction. We can show you how that's A, phased out, and B, when it stops again. And then the rules on charitable giving have changed just a little, but if some of the people on here are RMD age or over 70 and a half, the QCD rules, the qualified charitable deduction rules, they're actually looking better and better. But yeah, so just some of and then not listed on here, the estate taxes was locked in at 15 million, 30 million for a couple. So that really, a lot of people don't have what traditionally we call an estate tax problem anymore. So we can get into, I think, some more of the actual details. Yeah, our standard deductions. So these were I don't know if anybody, hopefully nobody remembers that years ago, these basically doubled. They tried to what they called simplify doing your taxes so that the standard deduction just included a lot more people. This was made permanent with the last passing of the bill. So a married couple filing jointly's the standard deduction is 32,000 now, and that increases a little bit every year. And then we'll get into in a minute some of the senior calculations, how you can really, if you qualify, get that a lot higher. If you're working right now, if you're still working, if you have a spouse that's working, these are kind of the 2026 retirement level contributions. This was tweaked and changed a little. Of course, your 401k, 403b limits went up a little bit. If you work for a smaller company, you might have a simple or SEP IRA. Simple plans went up to 17,000. If you're doing traditional IRAs or Roth IRAs, it's 7,500, and then jump down if you're over 50 years old, which probably most people are on this call, instead of doing the 1,000 that they've been doing, of course, the government makes everything complicated. This year's catch-up contribution is 1,100. So if you're over the age of 50 and you want to do a Roth IRA, you can do $8,600. Um, Also, the catch-up contribution for a 401k, you can add that 8,000 to the 24,500 level. So if you are working, being able to add upwards of 32,500 to a 401k is a pretty nice benefit if you can handle it from a planning standpoint, from a cash flow standpoint. And then just to complicate things a little more, a super catch up just for people between the ages of 60 and 63 is 11,250. So if you're in that age range, don't add the 8,000, add 11,250 to your 24,000. So instead of round numbers, they change these every year. And I think at the beginning, so much of this changes every year, and the numbers, even in my business, I've gotten to where I barely memorize these things anymore. You just have to go and look. What have the numbers changed? I'm this certain age. What do I get to contribute? So just look at these things, know where to go look, know where to go find them, and see what the limits are each calendar year. And like I said, just to complicate things a little more, we talked about your SALT deductions, your state and local tax, which your SALT deductions came back, but those will be if you make over 500,000, you won't get to take that full benefit. SALT, our state and local tax deductions went from 10,000 cap to a $40,000 cap in this year, but if you make over 600,000, you're all the way back down to the original $10,000 cap. So the senior deduction, we'll talk about that in a minute. That starts to phase out at 150,000 if you're married filing jointly. There's a new one for interest on a loan, a new domestic car loan. You probably heard a lot when you were talking when this was being passed last year about no tax on tips, no tax on overtime. Some of the fine print that did pass, but there's limits on it, and there's also if you make over $300,000, you start to phase out. If you make over $550, you don't get to take any of that deduction. So again, a lot of this is not to be memorized. Just know what your situation is and just look at the grid and see if you qualify or don't qualify as your income goes up. Looking at the senior, which probably speaks to a lot of people on this Zoom call today, the new senior bonus deduction, and you got to look at the fine print. This is for last year, this year through 2028. And I think in a slide or two later, it shows you how this sunsets and goes away again. Now, maybe everybody likes this and we come in and this gets extended too, but as of right now, we can do this for the next 3 years, this year and 2 more years. But if you're over the age of 65 and there's some fine print, you can't file married filing separately. You have to have a social security number. Each of you or each individual can get an additional $6,000 from a standard deduction. Now, this is pretty big because if you're married couple filing jointly, that's $12,000. If you're over the age of 65, you get your old standard deduction. I did my little cheat sheet here. If you're getting a standard deduction and you're both over the age of 65, you get that $32,200, and then you get another $3,300 that's always been there for older individuals under standard deduction, and now this new $12,000 you get to add to it for a total of $47,500. So that's really attractive to somebody who's not trying to itemize. You're over the ages of 65. Your standard deduction can actually be $47,500. So that's pretty big from a standpoint of helping you lower those taxes, especially in some of those lower income ranges. Of course, like I've kind of a common theme, this does start to phase out. If you're married filing jointly and your adjusted gross income is higher than 150, you start to get this benefit gets reduced over time. I mean, over the amount of money you make. So know it's there. If you qualify, that's great because it's a pretty big addition. You can make too much money and not qualify for it. And currently, don't get too used to it because it's only going to be around for three more years. This is kind of a quick, it's a little bit busy, but maybe some of it you can see. A lot of times when they pass these tax codes, these new tax codes, you'll probably hear that they have to be funded. They have to have the math has got to say this isn't going to cost us a ton of money in the long run. So you can't make things permanent. That's why the no tax on tips goes through 2028. The overtime, the senior deduction that we just went over, the auto loan interest, they're all new, but they'll all expire in 2028 if nothing has changed. Of course, not to make any sense, but the salt cap that we talked about going from 10 to 40,000, that goes through 2029. Um, but we did say the standard deductions got locked in. The estate tax exemption, when we were talking about that 15 and 30 million, that got locked in. One thing we hadn't talked about, you've probably heard a little bit of Trump accounts. We'll talk about helping out kids and grandkids in a little while, but Trump accounts, they did begin, and that is where you can, start with at least $1,000 of being funded. The government's the details have not quite been worked out yet, but Trump accounts are new. You can buy those for kids. If a child's born between 2025 and 2028, the government would help you start with $1,000, but parents and grandparents can still put money in those accounts. There's limitations, but just look into that if that's something that interests you. And at least for now, those have been made permanent. So just really a common theme. There's a lot of new things out there for last year, for this year. They might go away, so don't get too used to them. So you just have to look every year. And then depending on how much money you make, you may qualify for some, you may qualify for part of it, you may not qualify for any of it. So now kind of looking into maybe kind of on the back end, other ways. A lot of people through the years, you've heard save, save, save. You put money in a 401k, saving for retirement, and it's been great. You've got a pre-tax benefit. It's been a great way to help build up supplement income. You might have a state pension, you got Social Security, and then you've got a 401k. Now maybe that's been converted to an IRA that you're helping live off of. But the government says, yes, we've given you all this time where you can defer taxes. But what used to be 70 and a half, and then the Secure Act changed it to 72. Now the RMDs are required to start at age 73. And then again, this number keeps changing too. By the year 2032, it will have moved to 75. So in a couple of years, it moves to 74. Then eventually it moves to 75. So just kind of be aware what your number is if you're not quite 73 yet. It may keep changing on you. But this is where the government comes along and says, hey, we've let you defer all this money. Now's time. We're going to make you start taking it out. And my little cheat sheet calculator, it's basically a required minimum distribution is math based on longevity, average longevity of what the government thinks you're supposed to live. So at 73, in their lifetime tables, they think you're going to live an average of 26 and a half more years. So if you do the reciprocal of that, they make you take out 3.77% of what the value of your IRA or 401k was on December 31 of the prior year. At age 74, you have to take out 3.92. At age 75, you have to take out 4.06. So these are required minimum. You at least have to take this much money out. And in some of the fine print, the very first year, you can wait until April of the next year, but it starts to get a little complicated. So we normally tell clients not to overthink it. If you've got to take a required distribution this year, just do it in the calendar year between January and December. And then just run that calculation every year. Make sure you get it out because there's a penalty if you don't. Sometimes you can ask forgiveness, and that goes back to we're just tax planners. Talk to your tax professional. If you mess this up, grab your CPA. Hey, yes, what's going to be the penalty? There's a form somewhere I know I can fill out, say, and ask for forgiveness. So just know that's available. And because of this forced distribution, sometimes people later in life, between the other income that they're having, they're taking money out of an IRA that they don't even really need. And they're paying taxes on money that they don't even really need, or they don't need all of it. So we do a lot of planning around what can we do to possibly lower? How much is in an IRA or 401k before we get to required distribution age? So normally the best times for that is when you quit working. Let's say you quit working at 65. Is there a window from 65 to 73 that you'll be in a lower tax bracket than you will be once you hit R&D age? Can we do some different things? One of the main things we talk about is, should we do a Roth IRA conversion? You've probably heard a little bit about this in the past. This is really just trying to figure out, am I in a lower tax bracket now than maybe I will be in the future? Um, so if you are, if we come close to being calculating that you are, sometimes we'll do mini calculations. We'll do a little bit of money each year to kind of add to your taxable income. We'll probably play with those tax brackets like we were talking about earlier. Can we still keep you in the 12% tax bracket, but can we go all the way up to the top of it, convert some of my IRA to a Roth IRA? That'll get money from a taxable tax deferred account into a tax free account. And in theory, I'll be paying a lower bracket. I'll be paying lower tax rates now than in the future. The Roth is also attractive because it does not have RMDs. It does not have minimum distribution requirements. So that's nice. And then also, this is a really nice legacy asset to inherit for beneficiaries. They get to inherit it, and it's tax free to them also. So anytime we can get money in a Roth IRA, if the math makes sense, we really try to encourage clients to do that. And kind of what we talked about, looking at not only maybe your lifetime, but also your family's lifetime, your family tax bracket, heirs, families, kids and grandkids, whoever inherits your IRA and your Roth IRA with the current rules, they have to take the money out within a 10-year window. So when we're doing Roth calculations, conversion calculations, we not only look at your current tax rate and then what tax rate you're going to be in the future, but we possibly also look at what your family's tax bracket is in the long run. So just to kind of oversimplify, are you in a higher tax bracket now than your kids are? Then we probably just leave it alone. We don't convert a Roth. We just leave it in your IRA. But if you're possibly in a lower tax bracket and then your kids are doing really well for themselves and they're in a higher tax bracket, and then a lot of times you even think, when are kids going to possibly inherit money? Maybe in their 50s, early 60s, when their highest earning years might also be their highest tax rates. Their houses are paid off, the kids are grown, they don't have any tax write-offs, and then they inherit a big old inherited IRA, which, I mean, receiving an inheritance isn't bad, but then that's just going to compound and be in an even higher tax bracket. So if we can figure out, are you in a lower tax bracket right now? Are your kids and whoever this money is eventually going to get to, are they in a higher tax bracket than you? That might be one more calculation that we do, saying, hey, should we be converting some of this, part of this IRA into a Roth? And that just, and it's not really on the slide, but we were talking about inheriting. We talked about charitable giving in a little while, but your 401k IRA, if you're charitably inclined, is really one of the best assets to start thinking about being charitably inclined, leaving to a charity, because the charity doesn't care. They don't pay taxes. So a 401k IRA is really one of the best, if you're charitably inclined, to leave that to charities, churches, whatever you're thinking about, and leaving some of your other assets to kids, grandkids, etc. Talking about giving money away, if you're going to do gifting, annual exclusion limit is up to $19,000 for this year. So that's, you can give $19,000 to anybody you want to, and you don't have to file a gift tax, an extra form on your gift tax. Now your gift tax limits are still huge; they're still in the millions, but you can give $19,000. If you're a married couple and you want to give to somebody, you can actually double that to $38,000. You can give $38,000 every year to any kids, to all of your kids each. And that's a good way to start giving money to a generation, maybe when they need it, instead of one of the things we try to talk to clients about is, well, if you live to be 80, 85, 90, when your kids do inherit this money, they're already planned for retirement. They're already there. So maybe if you can afford it, is giving them 19,000 or 38,000 now when they're in their early working years, trying to raise kids, not making a lot of money. Is it more beneficial to give it to them now than it will be to give it to them 20 years from now when they're set and they're doing fine also? Um, Consider other different ideas. Do you want to be charitably inclined, but you've got kids or grandkids that are working? Can you help them out? If they're working and they're earning money, can you help them fund a Roth IRA? I've got a couple of clients that the grandparents are basically doing matching contributions for the grandkids doing Roth IRAs. So last year, the kids made $7,000 and they took 3,500 and put in a Roth IRA, and the grandparents matched that, put $3,500 in the Roth IRA. You have to make sure their earned income is above that 7,000 or whatever your contribution is, but it's just a really nice way to kind of help out. If education is important to you, think about gifting to a 529. They changed the laws recently to where it's more valuable for a grandparent to keep it in their name. It doesn't penalize the financial aid. Currently, it doesn't hurt the financial aid when you're applying for schools, but it'll just help fund education. So if a parent's so inclined, put 19,000 for each grandkid in a 529 plan. Just some different ways to think about, tax planning, at least for the next generation. All right, so now we're talking about charitable giving. The charitable giving laws changed a little bit. That super deduction, a lot of people can't itemize anymore because if you're that one example we gave where the $47,000 with the standard deduction, the age deduction, and the now super extra 12,000, a lot of people aren't itemizing over $47,000. So it's great to give to charities. Charities need the money, but you might not be getting the charitable deduction that maybe in the past you did. Also, this year going forward, there's a 0.5% threshold of your adjusted gross income that you have to get over the hurdle before you get to deduct what you give to a charity. So annual giving to charities is just out of your normally these days is just the giving out of your heart. You love it. It's important to you, and you're almost not doing it for a tax benefit. But if you can think about bunching, or if you can save up your assets and give a larger amount, what's become really popular in the last couple of years is a donor advised fund. So can you grab 2, 3, 4, 5 years worth of giving? Again, you have to be able to afford to, but can you take a lump sum, $50,000, $100,000, put in a donor advised fund, and then you get the entire tax deduction that year. So that's really beneficial. So you can do a standard deduction for a year or two. Then you can do a really large contribution to a donor advised fund. That year, technically, you're itemizing. You get that large deduction, and then maybe the next couple of years, you don't. You go back to the standard deduction again. But what the donor advised fund gives you, it gives you this large chunk of money you can add. You can add assets. You can add different things to the fund. But you can take your time in the next year or 2 or 3 in figuring out what charity you actually want to distribute that money to. So if you were giving 50,000, you don't have to decide this year who gets the $50,000. You can add the 50,000 this year, and then you can give 25,000 this year to Meals on Wheels and 25,000 next year to your church or whatever else is important to you. So it's a way to get a large cash or a large deduction, but still give to charities over time that are important to you. And then obviously, a lot of people are talking about retirees. We were talking about earlier about various ways to get money out of that IRA that you've been wonderfully saved for over the years. But how do we get money out of that in a tax-friendly manner? The QCDs are some of the best things that we do for clients. They get to give to charities. They get to leverage the tax benefits. And it's just a nice way to, and also from a long-term tax savings, we get to use those pre-tax dollars. So this is weird, interesting too. This stayed at 70.5. So even though your required distributions keep rolling up from 72 to 73 and again, eventually 75, this lets anybody that's over age of 70.5 take money straight from their IRA it goes straight to a charity and it's not a taxable event to you. So basically, you can go back, you can take that standard deduction on the personal level, like we talked about, but you can still give to charities and you're basically saving the tax dollars of that distribution from your IRA. If you take out $10,000 and you send it to a charity, you send it straight to the charity, you are not paying taxes on that $10,000. I know there were several questions, people, and I know somebody said, I can't think of too many negative. I think somebody even sent a question in that their advisor didn't love a qualified charitable distribution. You need to make sure you don't need the money, obviously, but if you're giving to charities anyway, and you're losing the itemized deduction because of the new increased standard deduction, you're over the age of 70 and a half. This is a wonderful way to fund your charities. The limit's up to like $111,000. So unless you're giving really, really, really large amounts of money, if you've got money in IRA dollars that you don't actually need to live on, this is a wonderful way to give it to charities. I know I've kind of gone over a lot. I'm going to try to kind of bounce around and hit some of the questions that we've seen. Kind of a high level theme, though, is tax laws are changing all the time. And you can even see, even on the ones that are currently in place, they're changing. They have income thresholds. They're going to sunset in 4 years or 5 years or in 2028 or 2029, some of them. We're going to get a new Congress in a couple of years or next year, a couple of years, and maybe one of the things they do, they'll come in and change the laws again. So it's something you always kind of have to stay current on. Keep working with your tax advisor, keep working with your CPA and saying, how do these new rules affect me? Should we change how we're giving money to people? Should we lump sum some distributions? Should I do a Roth conversion? Here's where I am. Here's where my kids are. I want to give money to my grandkids. What's the most tax efficient way? I want to leave money to a charity when I pass, and I want to leave money to my kids. Which one of these assets do we leave to the charity? Do we leave the IRA to the charity? So just think about all those different types of things. A lot of the questions, one of the questions we didn't really touch on it today was IRMA. When you get to Medicare, some of you probably know that the more money you make, everybody pays a Medicare premium. But in terms of like this year's numbers, if you make over 218,000 as a married couple, then you pay a little bit more. You pay $81 extra a month for the same Medicare that we all have. And it's really not a large amount of money but it just doesn't feel good. And it's a cliff too. If you make $1 over the threshold, you pay it. It's not a sliding scale. So it just doesn't feel good that you're paying, if you make over 275, and again, that's a lot of money, but 275,000, you're paying an extra $203 versus somebody else on the same Medicare plan. So IRMA is something that you need to be aware of. It's a 2-year look back too. So a lot of times when people start taking their Medicare or start applying for Medicare, in the first year, they're looking back to a year they were earning a lot higher money than what they're living on. So sometimes those first year's premiums are really bothersome. That's also part of the calculation. If we start talking about doing a Roth conversion, we'll look at the tax bracket you're in. Yes, we'll look at the tax rates we're going to pay, but we'll really make sure we don't get close to that IRMA limit, because you don't want to do a small tax conversion that just puts you over the limit, but ends up costing you an extra thousand or several hundred, an extra $1,000 or $2,000 a year. That may or may not make that Roth conversion math work. I know somebody asked about a PIN. I mean, cybersecurity scams, people filing for your taxes early. So the government's come up with something called a PIN, a PIN number. I don't know a whole lot about it, except I've seen, you can go on, you can get your own PIN, and it just kind of helps you safeguard that you're the only one that can file your taxes on your behalf. So that's important. If that's important to you, you should do that. I'm going to keep clicking through some of these. I'm going to get to the disclosure page and keep talking, kind of answering some of the initial questions I had seen. A lot of people ask questions about, I'm done now. Should I leave my money there? Should I leave it at a 401k? Should I roll it to an IRA? There's a lot of reasons to roll it to an IRA. Some, the qualified charitable distributions, that's a big one. There's a lot more investment options normally in an IRA. Normally, an IRA, if you're working with somebody, might have higher fees, so you need to know what that trade-off is going to be. Um, and sometimes just from a legacy planning, from naming beneficiaries, IRAs are cleaner and easier to work with. But if you're doing that, make sure when you do that transfer, you're doing a direct rollover from a 401k or 403b to an IRA. Make sure you're not doing a withdrawal, because if you do that withdrawal, that's where they withhold taxes. That's a taxable event. You don't want that to happen. So don't, if you can help it, don't be cashing in your 401k. You want to be doing a direct rollover to a to an IRA. If you have Roth sleeve, what's been new in the past, some people have Roth IRA dollars inside a 401k, then you're going to do basically be doing two internal rollovers. Your pre-tax money is going to roll to a traditional IRA. Your Roth sleeve in a 401k is going to be rolling to your Roth IRA. So just make sure that you're working with your financial advisor or your tax advisor when you're doing a direct rollover, that you're not creating a taxable event. We didn't have a slide, but some people talked about, so the taxability of Social Security. Social Security is taxable. It comes at income thresholds. If you're below $32,000, it's actually not. It's actually not taxable. There's a range where between 30, and I'm talking about married filing jointly. If your income is between 32 and 44,000, half of it's taxable, and if you're over 44,000, 85% of it's taxable. If you remember some of the verbiage that was bouncing around last year when they were passing this bill, they were making Social Security not taxable. Really, what that meant was the increases in the taxability of Social Security hasn't changed. What that meant was the increases in the standard deductions and the age deductions and that additional $12,000 deduction meant that it was just a lot more people's income was going to come below these taxable Social Security limits because of the increase in the deduction they got to take. So Social Security didn't change, but maybe your income level came down to a point where the taxes on your Social Security income did change. There were some questions about donating to charities. We kind of hit on those. Charities need your money. If you can donate immediately. I don't say wait, but if there's a lump strategy, you're trying to do one of those donor advised funds, wait a couple of years and then do that lump sum and then give to those charities that you find helpful. One thing we didn't talk about, with the increase in SALT deductions going from 10,000 to 40,000, some people might be actually itemizing this year that they haven't in the past couple of years because they get to take a higher deduction for their state and local taxes. So that's one thing that maybe people that have been taking the standard deduction with SALT coming back, they might actually be able to do itemized again. So just know where that's going to land for you, planning going forward, give to charities when you can. Give through the qualified charitable distribution from your IRA if you can. Do a donor advised funds if you've got the funds and you've got the ability to. Somebody talked about selling second homes. You don't get your primary residence. You don't get that deduction of $250 for single, $500 for joint. Just know, did you rent it? Did you appreciate it? What did you buy? Did you do any improvements? Did you add to get to the basis of it? But at the end of the day, it's going to be whatever your basis is, minus what you're, taking out of what you're selling it for. And that's going to be those capital gains in that. So just know what the taxes are going to be before you, move that money to something else. If you're doing a 1031, that's a little higher level than what this call today is probably looking into, but really make sure you get that right because that's got some complications. If you've done right, you can handle that. You can do that. But some people ask about trust with IRAs, trust inherited IRA dollars being inherited by trust. Those got a little more complicated with the Secure Act changes where we went to the 10-year windows, the 10-year rules. So I still see people doing that sometimes. But that's really more of a control feature at this point with the trust because you've only got that 10-year window. So I could definitely say talk to your tax advisor, talk to your attorneys, make sure that what is the trust set up to do? How's it going to pay out if it's got qualified IRA 401k dollars going into it? And in any documents that are more than 5 years old, they probably don't have the right language to deal with the new Secure Act changes. So just make sure they're updated. Um, I know I've talked a lot about if any of these affect you directly, talk to your advisor, talk to your CPA and say, how does this affect me? Is this something I can do? Um, some of I know some senior centers, I know some different churches, some various organizations kind of help seniors do their taxes for free. Even TurboTax has gotten a lot better. So I'm a big advocate for using a CPA, using a tax preparer. But if you're looking down those, just kind of Google in your area, is a senior center or is an organization helping seniors do their taxes. Um, some of the fine print, I know we went over the calculation, upwards of $47,000 if you qualify for all those senior deductions. We talked about if you're working, if you're getting on tips, the tip limit is up to 25,000. So just be careful, when you hear no tax on tips, know that you qualify for all of that. If you are itemizing, the one new thing has been up now. You can give an above the line cash deduction. If you make a cash contribution, single is 1,000, joint is 2,000 that comes straight off your taxes. So that's really beneficial if you're not able to itemize and you're just doing the standard deduction. Did you give 1,000 or can you give 1,000 or $2,000 directly to a charity? You get to take that off, and that can't be a QCD. That can't be some of those other things we talked about. That's just a separate one-off. So if you can do that, do it. So yeah, kind of at a high level, when you're thinking about things throughout the year, what can you be doing? If you're still working, can you maximize your retirement plan at work? Can you do a Roth or a traditional IRA individually? Know what tax bracket you're in. Look at that grid. I think somebody earlier, I don't know if I can get all the way back to it. Somebody said, how do they help? Had a question on, how do I calculate what tax bracket I'm in? And it's really just looking at your earned income. What are you making? Sorry, it's up in here. There it is. What are you bringing in? What are you making? If you combine, what are you both making? Then take the standard deductions off of it. And then what's that dollar? If you're making $100,700, you're probably in the 12% bracket. This gets to be important if we are doing Roth conversions, if you're just taking money out of an IRA in general. You normally want to do tax withholdings on those distributions. So it's important to know, hey, I'm in the 22% bracket. So when I do a distribution, I need to take out more money. If I'm doing $100,000, if I'm withholding taxes, I'm probably only going to get about $80,000 net. So just knowing that, so you don't have any tax surprises when you do your taxes every March and April. Make sure in your legacy planning, you've looked at those 10-year rules from your IRA and your Roth IRA on who's inheriting those. Do that family math calculation. Not only what bracket are you in, but possibly what bracket are the kids in. A big thing for us, it kind of gets overlooked. Not only what are your spouse, each spouse is their primary, but what are your contingent beneficiaries on everything you own, even your investment accounts, even your bank accounts at the bank. Make sure you have TOD. Make sure you have POD on those. If you have investment accounts, should you do capital gains? We do a lot of as volatile as the market is right now, are you creating any capital losses short term? Should you take advantage of those? Should you wash those with capital gains that you're taking? So just kind of knowing throughout the year, not just waiting until December, looking at that investment account and taking advantage of any changes, especially with as volatile as the markets are. Use 529s. 529s are a lot more popular, especially now. If there's any more money left over in a 529, again, there's some fine print. Has it been enforced 15 years? Different things. But if there is and you qualify, extra money can be converted to a Roth IRA for that beneficiary. If that's a grandkid, and there's money left over, they can add 35,000 in today's dollars, the current math, into a Roth IRA from their 529. So those are pretty attractive. And then just if you're trying to time the deductions, look at the timing, and then not as much estate planning these days because of the limits are so much higher. It doesn't hit that many people, but just know what your income for your beneficiaries, what the tax hit for the beneficiaries on IRA dollars and things like that are going to be when you're thinking about estate planning. And I will probably, that's kind of it for the initial questions, Daryl, that I had. Did you see any more
Yes.
questions come in
What
possibly?
I saw one about car loans. It said they asked, so can we claim interest on a car loan, or
So yeah,
must you meet the 32,000 deduction first?
well, there's a new bill. I mean, one of the things, there's new auto loan deduction. You can deduct up to 10,000 per year in interest on a car loan, but you got to look at the fine print and make sure the car. Um, I mean, that one we look at, but that one the car has to be made in America. So you have to make sure your car qualifies. And then, yes, you can deduct up to $10,000 a year of interest on that car loan. It's through 2028. So that's one of those that does phase out. And you start losing that deduction at $100,000 for single and $200,000 for joint filers. So it does exist. It was part of that was one of the small changes to the new one. Just make sure the car qualifies and you get it done between now and 2028 and you don't make too much money in those phases.
It just okay. There was another one. If you take out funds from a Roth IRA and want to pay it back after selling a house, how long do you have to deposit the funds back to the Roth without any tax consequences?
Um, I am 99% sure it's 60 days. Those are some of the rules that I don't think have changed on us through the years. Um, so but that's something I would double check. But I know we had one client that had to take an IRA distribution a while back, and we were able to get most of the money back in, and we had 60 days for their traditional. So but I would just double check with their tax advisor to make sure I've got that timing right.
Yeah. Okay, and then I'll do two more questions. One person just wants to know, are the tax brackets uh, gross or after tax, gross or net?
Those are your taxes. So you have your
Yeah.
adjusted gross income, which is like the
Yeah.
bottom number on your very first 1040, and then you take your standard deduction off of that. So if you to oversimplify, like if you made 132,000 and then you're married and you got that 32,000 standard deduction, you take that off, and that $100,000 is what hits that grid. So that would be part of it would be none, part of it would be 10%, and part of it would be
Mhm.
12%. So it's your
Okay.
taxable income. So I'm oversimplifying a little because there's a couple more boxes, but it's your adjusted gross income minus your standard deduction or your itemized deduction, then your taxable income.
So one person asked, can you donate directly to charity from a traditional IRA before age 70 and a half?
No, that's the one, the qualified charitable, no, before 70 and a half, it's a taxable distribution. So you can still do it, you pay your taxes, and then you donate to the charity, but the benefit is 70 and a half, you qualify for that qualified charitable distribution. It's not a taxable event.
Okay, so this one kind of relates. Can you do a charitable contribution directly from your 401k like you can an IRA?
Most 401k providers aren't set up to handle it. They can't do it. It's not to say, I think in the tax code they can. Like I think 401ks and IRAs are set up the same way to be able to do that. but I know most 401k providers don't have that mechanism. So if that's beneficial or important to you, you might be rolling your 401k, do a direct rollover to an IRA, and then do it.
Okay. All right. Kevin, thank you so much. This was definitely a most informative webinar. I know I learned a lot today as well because it is confusing, to think about all these different ways, strategies, brackets, everything that folks have to work with when you're doing your taxes or thinking about your taxes each year. So we totally and we appreciate you joining us today. And so, audience, we thank you as well for joining us today. So, I have a few announcements before we leave today. Don't forget to complete the survey we will be sending you later this week. And again, it's quick and easy to complete, and we need your responses back by Monday. Before we leave, note that the next Lunch and Learn webinar will be Wednesday, April 15th. That's tax day, by the way. So how timely, right?
Yeah.
April 15th at 12:30, entitled COLA Considerations, the Data and Discipline Behind Determinations. Our own North Carolina State Treasurer, Brad Briner, will be our speaker. You will not want to miss that, so please plan to attend. We will continue to strive to ensure that you are getting the most out of your membership and benefits with RGEA. And if you have any ideas about webinars, please let us know that. Kevin, I want to thank you again for your presentation today. And everybody have fun doing your taxes. I mean, we learned a lot today. Or call Kevin. He left his number there. So thanks again for joining us. And as always, the association stands ready to assist you in your retirement. Happy Wednesday and stay safe.